If you have watched my recent video, you know that most people in Japan will never live off dividend income. But dividends still matter when they are done right. So today, I'm sharing with you 7 dividend ETFs I personally researched for my own NISA account. And I actually hold 1489 myself, and I'll show you why. Plus 6 other NISA eligible options that actually make sense for building steady long-term income. We'll cover yields, fees, ticker codes, and which ETFs fit different risk profiles, from conservative to aggressive. Starting with number 1, the next from Nikkei 225 high dividend yield stock 50. Its yield is around 3.4 to 3.8% with an expense ratio of 0.28%. Distribution is semi-annual, so twice a year, and I like the nickname of the heavyweight champion. 1489 tracks the Nikkei 225 top 50 dividend payers, giving you instant exposure to Japan's blue chip income stocks. It has a very strong yield compared to a typical Japanese asset, very reasonable cost for a focused index, and it concentrates in financials and utilities, which are proven dividend-paying sectors. It has a massive AUM, or asset under management, and offering a lot of liquidity. And as I mentioned, yes, I personally hold this one in my own NISA account. And I think that it's really good for beginners who want a simple, pure yen-based dividend income. The trade-off is you only get 50 stocks, which is super concentrated. But for dividend investing, this focus is on a strength rather than a weakness. Now let's go to number 2, which is the Nomura Japan Equity High-End Dividend 70, ticker 1577, with a yield up to 3.7%, an expense ratio at 0.32%, with a distribution that is quarterly, so every quarter, 4 times a year. And the nickname I gave him is the stable grower. It expands to 70 stocks, compared to the previous one that had only 50 stocks. And he screens for dividend stability and long-term growth, not just high yield, which is, I think, quite important. And the reason I think it stands out is it has better diversification than 1489 that we just saw, a strong historical dividend growth track record, and quarterly payout, meaning smoother income flow for you. And his focus on companies that maintain and grow dividend over time is also a strong point. So it's really fit for investors who want reliable, growing dividend, not just the higher number just today. If the information has been useful so far, please give this video a like. It really helps the channel grow. Thank you so much. Let's continue. Number 3 is the Global X Japan High Dividend 30, ticker 1651. Its yield is up to 2.5% with an expense ratio of 0.19% with quarterly distribution. And the nickname for this one is the Quality Anchor. This one intentionally chooses quality over raw yield. Only 30 companies, each screen for financial strength. So why the low yield, you might ask? So the firms, those 30 companies, have very strong balance sheets, better payouts to stability, and lower earnings volatility. In a market downturn, like we may be entering right now as we are recording this video, quality companies protect your dividend stream better than high-yield stocks. So I really think this is for long-term NISA investors who want a low-fee, low-stress, sleep well at night core holding. And now number 4, which is the Daiwa i3 ETF Bloomberg Japan High Dividend 50, ticker 2529. It offers a yield of 3.2 to 3.5% with an expense ratio of 0.25%. Distribution, semi-annual. And the nickname would be the balanced sweet spot. This ETF uses Bloomberg's quantitative screening, not just yield, but payout sustainability and earnings quality. And what makes it really interesting is that, of course, it has a higher yield than 1651, better quality screens than pure high-yield ETFs, but it is still competitively priced. It's a good middle-of-the-road exposure, if you will. And I think it's best fitted for investors who want above-average yield with solid fundamental quality, not one or the other. Middle of the road of our list, we're at number 5, the Global X MSCI Super Dividend Japan, ticker 2564, yield of up to 4.18%, with an expense ratio of 0.45%, quarterly distribution. And the nickname is definitely the Yield Booster. This is the highest yield ETF on the world list, but also the one with the highest risk. And the reason for that is because super dividend strategies target the absolute highest yield stocks, which often means more cyclical sectors, turnaround situations, and companies with unstable earnings trying to boost with dividend, trying to boost their stock price. But at the same time, it has benefits, right? Quarterly payouts, very attractive yield, especially in a tax-free account like the NISA one. So I think it's really useful as a satellite position for boosting the income of your overall portfolio. And obviously, it's best for aggressive investors, not your primary holding, but a powerful add-on to boost the overall yield of your portfolio. And that brings us to number 6, which is the iShares MSCI Japan High Dividend ETF, ticker 1478. The yield is between 2.4 to 2.5% with an expense ratio of 0.21%. Semi-annual distribution. The nickname would be the institutional grade option. This one is backed by MSCI rigorous methodology and BlackRock scale. So why is it so different? It uses a broader Japanese universe. It captures mid-caps that other ETFs might miss. It has a very low cost considering the methodology it's using, very solid asset under management as well, and a very strong execution and institutional grade screening process. I mean, we have MSCI and BlackRock together. So it's best for investors who value quality index construction and want a low-fee, diversified dividend ETF without sacrificing yield entirely. And now we arrive to number 7 in the list, the last one of the list, and that's the one ETF, High Dividend Japan Equity, ticker 1494, offering a yield up to 3% with an expense ratio of 0.308%, semi-annual distribution, and the nickname would be the Dividend Aristocrat Tilt, because 1494 tracks dividend consistent companies, the closest thing that Japan has to dividend aristocrats that are so famous in other markets. So the reason for really considering it is the solid performance track record, very strong consistency in dividend increase year over year, balanced yield and cost, and a highly regarded ETF receiving a silver rating from Morningstar. The trade-off is that it won't outperform during high growth tech rallies because it prioritizes stability over growth. So it's best for moderate risk investors who want steady, ratable Japanese dividend exposure with a proven track record. So after all of that, which ETF should you buy? To make it simple, here's an idea of typical portfolios you may want to consider. But before I show it to you, remember, I'm just a guy on YouTube sharing what I find for entertainment purposes only. Do your own research and talk to a professional before any investment decision. With that said, let's have a look at the first idea portfolio. This one is a conservative portfolio, meaning low risk. You could put 50% in the 1651 for quality, 30% of the investment for the 2529, which is balanced, and 20% into the 1577 for stable growth. If you're a balanced investor with moderate risk, which most people are, you could consider 40% in the 1489 with the core high yield, 30% in the 1577, growth and stability, 20% in 1651 for quality anchor, and maybe 10% in the 2564 for boosting the overall yield. Now, if you are an aggressive investor wanting really high risk, but also high return, 40% in 1489 foundation yield, 30% in the 2564 for high yield, 20% in the 1577 for balance, and 10% in 1494 for long term. Now, what actions you could take this week to immediately put all of this into practice? First, open your SBI or Rakuten or Interactive Brokers account if you haven't already. And if you are abroad, check with your broker if it offers access to these ETFs or any alternatives actually. And search for these ticker codes and start with one ETF. Don't overthink it. Don't take everything at once. Let's set up a monthly automatic NISA purchase or any account you're using and reinvest your dividends for 5 to 10 years to grow faster and add one ETF at a time progressively. Here's the bottom line. Dividend ETFs in Japan are not a magic path to living off passive income, and they never will be for most people. We already discussed that in a previous video, but they are a powerful way to add stability to your portfolio, build long-term cash flow, reduce volatility, and grow tax-free income inside your NISA account. And as long as you see ETF as one layer of your total return strategy, not the entire strategy, they can help you build a much stronger financial foundation over time. Now, if you are young or still far from retirement, focus on growth broad market exposure and low fees first. You can always shift toward more dividend-focused ETFs as you get older. And if you're closer to retirement or want a more stable portfolio, dividend ETFs become a much more meaningful part of the mix. What matters is not chasing yield, it's building wealth sustainably. If this video helped you understand how dividend ETFs fit into a realistic investing strategy, please like and subscribe, it really supports the channel. And if you missed the first video where I explained why most people can't live off dividend in Japan, you can check it here. And there's another one here as well. Next time we'll talk about the financial mistakes to avoid when living in Japan or anywhere in the world. You definitely don't want to miss it. Thank you again for watching, and until next time, goodbye.